Stock market crashes immediately, same day, probably goes on for several days. Interest rates pop same day. For me, the average person starts to see the commercial pain probably in a quarter, right? It would probably
Yeah.
take 90 days to ripple through. And then to your point, the next quarter, you start to see layoffs. You start to see, you actually, I think if you go a quarter point, it shocks the system so hard uh, that you get a negative GDP print probably the quarter after. Anna, I got to ask you a question. It's a very important question. Let's play a game. Let's pretend that Jerome Powell and all his Fed cronies today, right? Jerome Powell is speaking today, comes out and says, we have taken the challenge of inflation seriously. The last 3 months have been rough on inflation, and we are raising the Fed funds rate a quarter point effective immediately. Not at a meeting, doing it today, Tuesday, April 16th. What happens? Fed just raised rates in an emergency meeting. What happens?
You know what my first thought is? You're going to laugh. Do you remember the movie back in the 80s, War Games? Will
I
you
do.
play a game or something
Yeah,
like that?
yeah, yeah. I
It's
remember.
like it would tank the markets, in my opinion. So that would be the first thing I would say, because the markets are still expecting and hoping for a Fed rate cut. So keeping rates the same won't make them freak out as much, because they also see the prints that are showing that we're in a more inflationary environment over the last couple months. But I think raising rates would definitely impact markets, especially many of the companies who are already missing the mark on profits, and seeing kind of a stagnating economy, a very bifurcated economy. So I think companies would be realizing more pain, realizing they've probably raised rates as their own prices for profits as much as they can in many different sectors other than generally the services sector. So I think that's the first thing that I would say, is that I think markets and companies would their values would go down. But not only that, and this is for those that are already profit constrained. There are going to be some companies, Michael, that inflation is actually good for, and there are some of the top in the S&P have 10% profits over the last couple of years. So they've been pushing and continuing to get profits. So I think the markets will be somewhat bifurcated. But the other thing I think you're going to see is you're going to see more layoffs. Like, that would be very quick, because they're going to realize that as costs are going to be going up, as input costs go up, and as their debt service, that many of them haven't quite yet finished having to roll over into new loans, as that debt service goes up, they're going to say, it's time. We need to start letting employees go. So that would be my first two big predictions.
Yeah, when I think about it, and again, we're talking emergency meeting, nobody saw it coming, no telegraphing, just hey, Jerome Powell picks up the microphone and says, hey, congrats, rates are up 25 basis points right now. I think the stock market has a conniption, right?
Yeah.
I think crypto, I think all risk assets have a conniption. And we're talking, 5, 6, 7%, kind of a rush to the exit. I think that's frankly, I think that's an easy call anytime the market is shocked like that.
Yeah, so the fool's gold of Bitcoin, as Peter Schiff likes to call it, will go down, but gold and silver will rally.
Okay. Yeah. The other thing I think about, again, given our world, is interest rates. Again, we're talking emergency meeting, a shock, not telegraphed. They would go up, and I would argue they would go up by more than a quarter point, because I think what would happen is the market would be, because right now the market is telegraphing with a
Right.
slight down, right? They're not talking up at all. But if the
Right.
Fed comes out, bangs it with an emergency, they're going to immediately start pricing in more hikes. That's how the market works.
Right.
And you could see mortgage rates, we're talking homeowners, go to 8.5 or 9, right? It would be that much a shock out of left field. Do you see that as possible as well?
Absolutely. Yeah, because what a lot of people don't realize is that the mortgage rate is not a 1-for-1 to how much the Fed funds rate goes up, or even the US Treasury, because it's that plus a spread, a risk premium. So I've talked a lot about on this show how I think more as like an institutional investor, even when I'm looking at, single family homes, because anytime we're investors, we're saying, okay, if I could park my money in a risk-free rate of return, which has always been that, 10-year treasury, I need to make more if I'm going to take more risk to invest in something else. And so those people that are holding mortgages, because most mortgages, you get them from a bank, but they're selling them on the secondary market as a mortgage-backed security, they need a risk premium that says, I'm taking risk that I'm buying a mortgage at a rate today that could even go higher in the future. And then I'm losing money compared to inflation, or not having that same risk premium anymore. So that's why your mortgage interest rate can go up higher than the Fed funds rate does.
Oh,
So
yeah.
I agree with you, because what we saw is that risk premium and that spread has been above the treasury in general. 30-year fixed mortgages are not exactly tied to a 10-year treasury, but the treasuries in general between short-term and long-term. But that spread started coming down as everybody
Correct.
anticipated that rates were going to go down. And so if rates go back up, it's
Bam.
more uncertainty, and you're adding more than a quarter point to mortgages. So I agree
Oh,
with you completely there, Michael.
yeah. The spread, I think I looked at the numbers yesterday. The spread currently is at 268 basis points. For a long time, it was over 310. So there's 50 basis points in just spread expansion on top of
Right.
the quarter point. So again, stock market down, mortgage rates pop immediately. The next thing that I think happens is commercial banking locks up and starts cracking, because you would have a lot of,
That was my next thing
yeah,
as well. Yeah.
yeah, you have a lot of lending stops, right? Again, it freezes the system. They start looking at the assets that they need to refi. And in my opinion, my words, there's a lot of people holding on by their fingernails. If you whack them with another 75 basis points, or shoot in commercial, maybe 100 basis points, they're just going to give up. They're going to be like, take the building, I'm out, no personal guarantee. So, I'll just give you the bill. There would be no new lending, and they would be absorbing losses like never before.
Yeah, and here's the thing, the commercial real estate, I mean, I agree with you at a high level. There's some nuance differences maybe. One of them is that it would start. It's already started, right? So
True.
usually you wait till you're in a recession before commercial lending starts to dry up, but we're already seeing significant credit tightening. A
Oh yeah.
year ago, we had development deals that went from, being pre-approved at 5% to 9 to 11, and instead of 75% LTV, they're offering us 55%
Oh
LTV. That's to,
yeah.
very experienced commercial operators with very high net worths, lots of liquidity, and still, that's like best execution. If you really know what you're doing and have financial stability and experience, already you're looking at 55% LTV. I've heard, Ken McElroy recently speak of very similar numbers, in the 10 to
Yeah,
11%
he
for
did.
his development deals, and offering 55% LTV. So they're on hold as well. So you have a lot of developers who have deals on hold, which is just going to completely bring supply down. There's not going to be new construction. You just can't make the numbers work with the spreads and the rents that you can get today. But the other thing is, if rates keep going up, again, similar to the risk premium with residential mortgages, the banks say, wait a second, we don't want to lock in either at these, 20-year loans.
Mhm.
Typically, sometimes if you go Fannie Freddie, you can go 30, but most banks are 20-year loans. And they don't want to lock in rates that they think can go higher too. So you have a higher risk premium. I think they raise their debt coverage, that debt service coverage ratio, meaning that you've got to pay much, much less and have more profit, more net profit before you even make that mortgage payment. So I think they lower LTVs, they raise debt coverage payments, and maybe you can borrow at 50, 55% even stable assets, if rates continue to go up. The other thing that happens though, as rates go up, this is different somewhat from residential real estate, is that your cap rate also goes
Mhm.
up,
Yeah.
meaning the value continues to go down. So we've already seen 30 to 40% haircuts off of values of commercial real estate across different asset classes of commercial. That starts to go, even worse. And I saw today, there was an article, I think it was on AG Globe, I'll have to go back and double check, but how cap rates for at least Class A had started to slightly improve to about 5%. Now, Class A stuff, Michael, before all of this started was, trading at 3.75%, 4%. And now you're looking at, things have finally stabilized at about 5. I think you start to see that reverse again as well, because again, why would an institution park their money at 5 if the treasury rate's going to go up over 5? And it's very close to that already. So it would not be good. It would be very difficult. And I'll just add this one last thing. It would cause more operators to default that are already operating on the mantra survive to 25. That's kind of the commercial mantra. If you could just survive to 25. First it was 24, then it was 25. But because those deals are going to default, it gets us closer and closer to a banking crisis. And many will say, no, the banks aren't really that stretched, but I'm sorry to tell you that is just flat out not true. And Tom Honig, who used to be the president of the FDIC and was a Fed governor on the FOMC that sets rates for years, he came out last week and said he thinks we're at a 4 to 5 risk of banking crisis, that the banks are not as stable as the Fed and the Treasury tells us, and that if rates stay higher for longer, you're going to have lots of defaults of businesses and commercial real estate with these variable rate loans that are going to cause banks to, become insolvent and have to fail. That's just the reality. So it would be very bad, Michael.
Yeah. So again, I think when I kind of play the dominoes out, stock market crashes immediately, same day, probably goes on for several days. Interest rates pop same day. For me, the average person starts to see the commercial pain probably in a quarter, right? It would probably take 90 days to ripple through. And then to your point, the next quarter, you start to see layoffs. You start to see, you actually, I think if you go a quarter point, it shocks the system so hard that you get a negative GDP print probably the quarter after, right? I think this quarter, for example, it's just starting, but I think there's enough momentum to get you through Q2. But Q3 would be a negative GDP print. And then, in my opinion, the Fed would be like, this is how wild it is to me. The Fed does this, all this calamity happens. Then the Fed comes in, I don't know, 120, 150 days and cuts, they have to cut rates a half. They raise a quarter, bad stuff happens. Then they cut a half to kind of put out the fire. You actually get a recession, negative GDP, unemployment pops from 3.8 to 4.8, 5.1. Inflation goes to nothing, right? Because people just conserve. So I don't know. If you really want to beat inflation, maybe you surprise with a quarter point rate hike, and then you a half a basis point in 100 days. I don't know.
I can hear the comments now saying, we're being total doomers, but here's what pops in my mind. So, late last year, we said, okay, we think inflation's going to be, here for a while. The Fed's probably not going to cut, quite as quickly. And then we played a couple months ago, what if there are no rate cuts this year? And I think most people didn't think that was very likely. And I think I might have said 30% chance of that, right? But since then, I'm like, I think there's a 75% chance of that, because we've got such strong data, inflationary data, and somewhat positive GDP over the last couple of months. So what I've learned is that as soon as you're sure about something, something changes. Like, look what, and that doesn't even take into effect Iran attacking Israel this last week, and what that can do to oil prices. And we haven't seen, if Israel is going to react, if they're going to do something else, to show their strength. We just don't know. But the Middle East is definitely something that could cause inflation to go up, and have an energy shock. And what we learned in the 70s, it wasn't just Paul Volcker raising interest rates. There was also oil shocks and threats of war. And we're in a very similar situation today. And so nothing is off the table to me. I think that inflation could get worse. I've been saying, I think inflation, and we did a video last week on inflation being a feature, not a bug. Like, we're in for a more inflationary decade. The
Yeah.
only question to me is what happens in the interim? Do we have such a bad recession or banking crisis, even without an interest rate hike, that it causes the Fed to have to drastically cut despite inflation to save the system for a while?
Yeah.
Or do they let certain things start to fall out and let it get more recessionary, hold rates stable? Or do we have an oil, shock that makes them have to raise rates? I would give the probability that they raise rates probably the 25 to 30% that I thought it would stay
Mhm.
flat,
Yeah.
because I think they know that if they raise rates, they have to know they will cause a deep recession. And then they're really going to have their hands tied because they can't fight both inflation and recession at the same
Yeah.
time. So I don't think this is going to happen.
Mhm.
Um, but we just don't know. There's so many external factors that could cause it to happen. So I think we have to keep an open mind as to
Yeah.
where interest rates may go, and hedge accordingly, diversify a little bit so that if rates go up, you've got something that can, do well when the market crashes. So I did a post. I don't know if you saw it, Michael, yesterday or the day before. I have been out of the stock market since the GFC,
Mhm.
100%. Other than a couple of years ago, I started to, buy a few things, Amazon, Microsoft, BP, Oxy Oil. I bought a few things, but I have a very, very tiny amount of my net worth in the stock market. But I just last week and this week started to go into some defensive stocks, things
Mm.
like we've talked about, hard assets, commodities, right? If we have an inflationary shock or a more inflationary decade for the long term, even if we have a recession in the short term, the things that tend to do well when equities crash
Mhm.
are gold and silver and real estate. Maybe
Yep.
not commercial real estate because they're very interest rate sensitive, but residential real estate, healthcare stocks, military stocks, agricultural stocks, fertilizer, commodities.
Mm.
Commodities haven't done great over the last decade because equities have done so well. But those are the kind of things when I say you need a hedge for possibilities that we either have higher inflation for longer or we have a deep recession, things are going to do differently. So it's more important than now than ever, in my opinion, Michael, to diversify at least some of what you have and to buy hard assets, which is why I'm still buying real estate.
There you go. We're going to talk about that in episode number 3 today. But before we get to number 2, how can they find you, Anna?
Great. You can find me here every week on your show and on my playlist on your channel. Social media, Anna Kelly, REI Mom. And if you are looking for consulting or coaching, you can find me at annakellyinvesting.com.
Thank you so much.